Is the US going to get directly involved in the war with Iran? What are the markets saying? So, overnight, there was a bunch of news. President Trump cut short his G7 meeting kind of abruptly and flew back to Washington, D.C., where he had scheduled a meeting with his National Security Council. This has been kind of, on everyone's lips right now. Everyone is wondering, is the US going to get directly involved? Well, here is kind of currently what the markets are indicating. So the S&P 500 opened up lower on the day, gapped down about 0.5%, which I think that the mere fact that it did not gap down more significantly is a positive sign in terms of not getting involved. We can see from the low currently about 1 hour into New York session, it's bounced by about a third of 1%. This is not overwhelming buying, but it's also, I think, significant that it hasn't sold off. I think the S&P, is probably a good risk barometer, especially given the S&P 500 right now is so heavily weighted towards kind of the momentum Mag 7. The fact that the S&P 500 is up now, Mag 7 is down 0.6. NASDAQ is down about a third of 1%. The Dow is basically flat on the day, and the IWM is only down a third of 1%. Again, I think the equity market is indicating that concerns over imminent involvement by the U.S. Are misplaced, and the likelihood of the U.S. joining in offensive operations in Iran seems to be low. Now, the dollar is up about 0.2%. I think a couple interesting things with currencies. So the euro is down, the yen is down, and the franc is about flat on the day in terms of the U.S. dollar cross. Those had been acting as kind of the safe haven bid in place of the dollar. So I would say that the FX moves you could interpret kind of either way. The fact that those safe havens, like the franc and the yen, I think the fact that they're not rallying meaningfully, 0.5%, 0.75%. I think that that is a positive indication, again, indicating that the market is not super worried about the U.S. getting directly involved. The volatility index, remember, this is what people call the fear index or the fear gauge. This opened up overnight. This opened up much higher than yesterday's close. It opened up at about 20.5 and has been coming in basically all morning. Again, this is not what you would expect if the market was super worried about imminent involvement by the U.S. What this indicates is that more investors are selling volatility than buying volatility. And generally, especially when it comes to hedges, generally speaking, if investors were rushing out to hedge by buying puts, what you would see with the VIX is a move up, not a move down. Move down would indicate people are more investors than not are actually selling volatility, selling calls, and selling puts, which indicates that they do not believe that there will be, elevated volatility or an increase in volatility. That is what a lower VIX indicates. And also, I think it's notable that we have a Fed meeting tomorrow. A lot of times you'll see the VIX move a bit higher as investors hedge for that Fed meeting. The Fed meeting is historically super, super volatile. So generally speaking, you can see the VIX move marginally higher as investors are kind of trying to get ahead and hedge that volatility. Now, some of that hedging could have already been done. We have seen the VIX move, significantly higher from last week. So some of that hedging could have already been done. Implied correlations opened up just like the VIX opened up higher. Remember, implied correlation, when this is higher, that indicates that basically everything is getting sold. A lower implied correlation means kind of more concentration in terms of the moves in the equity market. The move index yesterday down marginally. it is in this kind of general downtrend, even though we have seen yields rise, which I think is interesting. Both Friday and Monday, we saw yields rise. I believe the 10-year over those 2 days, Friday and Monday, the 10-year yield was up about 16 basis points. So that's generally not what you see in the face of kind of heightened geopolitical issues or especially concerns over imminent U.S. involvement. Here's crude. So crude is basically on a daily basis right back to where it was on Friday's close, ever so slightly higher. Again, I think that if there were concerns over escalations, right, like really heightened geopolitical tensions, right, this conflict escalating, with things like Iran trying to close the Strait of Hormuz, where 25% of all oil transits through. I think you would see oil moving kind of much higher. I mean, Friday we had at one point a 14% move upward. It moved lower overnight and has been popping a little bit. It's up about 3.1% on the day, but I don't think that this is, you could argue that this is kind of in the direction of maybe slightly heightened tensions. But I think if there were risks or if the oil market and traders, market participants were worried about significant escalations, I think you would see oil moving much, much higher than it is currently. Gold is down on the day. And in fact, yesterday it was down too. I think this again indicates that the market generally gold is seen as kind of the safe haven. Some people call it, part of like the Armageddon trade, because gold is gold. You don't need the internet. You don't need a bank, right? It's a bare asset that you own. And so it can be seen as kind of a safe haven, especially when it comes to geopolitical issues. But over the past 2 days, gold is down. Now it's not down, meaningfully, but the fact that it's down at all over the past 2 days is again yet another kind of indication that I think that it, indicates in the direction that there will not be kind of imminent involvement by the U.S. And then when it comes to yields, I did want to point something out. It's not on the news with Iran, but the short term bill market appears to be pricing in a likelihood of a default. So right now you have the 1 month yield at 4.18, you have the 3 month yield at 4.33, the 6 month at 4.30, and then the 1 year at 4.1. So you have like a little bit of inversion where the debt ceiling debate, that is August, right? That's 2 months away. And what you see is a bit of a kind of hump or dip, depending on how you look at it, with the yield for that particular kind of duration or when that would be coming due. So I think that's interesting. But generally speaking, when it comes to the bond market, yields are up again, yet again today. The 5 year is about flat on the day. The 2 years about flat on the day. They are well off their lows. But they are all about flat on the day. The 7 years down about 1 basis point. The 20-year is down about 3 basis points, and the 30-year is down about 3 basis points. You could interpret this as a bit of a safe haven trade. This indicates buying of U.S. Treasury bonds. But kind of on the other side, you could also argue that this is kind of one of the reasons that I believe yields were moving higher despite very strong auctions, right, last week and then again yesterday. Yields have been moving higher on both Friday and yesterday. Like I said, about 15 basis points for the 10-year. I think part of that was on risk of inflation, right? If oil goes to 100 or 120, that'll have a negative effect on inflation. That'll move inflation higher. Yields should move to kind of price that in. The fact that yields are coming down, this is buying of treasury bonds, right? The value of the bond is going up inverse to yield. You could argue that this is pricing out some of that concern when it comes to kind of oil price spiking, right? If the bond market believed oil was going to, I don't know, $120 a barrel, I think you would see yields moving higher. Now, they are off their lows of the day. We also did get weaker retail sales data today than was expected by the street. So, again, yet another kind of macro driver, fundamental driver that could be pushing yields ever so slightly down. Again, they're up, marginally a couple basis points off the low of the day. But yeah, right now, to summarize, it doesn't look like the market is super worried about huge escalation in this conflict. Whether you look at oil, gold, currencies, equities, volatility index, everything seems to be indicating bonds too. Everything seems to be indicating that the market is not super worried. So if you're an American and the overnight news has kind of been concerning you, or you were up late last night, waiting for the shock and awe moment, right? I'm old enough to remember that with Iraq. I think at least there are some positive signs with the market. Now, look, of course, the market can get it wrong, but the fact, I mean, we just went through many different assets, and the volatility and implied correlations. We went through a lot, and pretty much all the signals are indicating that there's kind of the market is not pricing in an imminent risk of a huge escalation. So if you're American, or you were worried about it, even if you're not American, I would say right now at least the market is indicating um, that the concerns over huge escalation are misplaced, and it appears the market does not seem to see that as a likely possibility. Now, things can change. Of course, we will keep an eye on it, and we will also be doing a video tomorrow. There is the FOMC meeting and the press conference. We get a new dot plot, so I will definitely be making a video tomorrow with that. But I would recommend, keeping an eye on oil. I think oil is probably the best indication of, if you're trying to evaluate the likelihood of huge escalation. I would say oil is probably the best metric to watch. And so, yeah, anyways, hopefully that was helpful. Hopefully it put your mind at ease a bit. Definitely, being an American here, I was, pretty worried about it. Never like to see war. So, yeah, hopefully that put your mind at ease a little bit. Now, markets can get it wrong, but at least currently, they are not worried about a huge escalation. Anyways, I will catch you in the next one tomorrow.